Hello, everyone, and welcome to our webinar, Economic Uncertainty and the Impact on State and Local Governments. I'm Corinne Aycock here from Avenue, and I'm so happy to be your host today. And so excited that we have so many new faces and returning faces, and we've built quite the following. And that's in large part because of our partnership with UCLA Anderson Forecast. Avenue is honored to partner with UCLA Anderson Forecast, an organization with a 70-year history of producing some of the most accurate forecasts for our country. Together, with Avenue's 40 years of experience in serving state and local governments, we hope to provide you with meaningful insight into critical topics. Now, we've got an awesome guest lineup for you today, and they are experts in their field. It is my pleasure to introduce Dr. Jerry Nicholsberg, Director of the UCLA Anderson Forecast. Welcome, Jerry. We're all looking forward to your forecast today.
Always a pleasure to be here with our friends at Avenue.
Well, thank you. And Avenue's Fran Mancia, Vice President of Government Relations. Welcome, Fran. Always great having your insight. Thanks for joining us.
Thank you.
You can learn more about each of our speakers by reviewing their bio in the briefing doc that was sent to you in your reminder emails. Now we've got a full agenda and lots of ground to cover. We're going to begin with a brief legislative update by Fran, then move over to Jerry's economic forecast, which analyzes the latest data for income, labor force, and consumption rates, and how these factors shape our economic landscape. We'll examine housing trends and the impact of sales tax and property valuations, and discuss the current geopolitical risks and how they're impacting all of us. I'm sure you're going to have a ton of questions, so please don't be shy and use the chat feature to ask along the way. And with that, I'd like to turn things over to Fran for his legislative update. Fran?
Great. Good afternoon, everyone. Thank you, Corinne. It's a pleasure to be here with you. Just a brief overview on federal and state legislation, and I think it ties nicely into the presentation today. You know, the big subject of the state and the federal level, aside from the typical partisan issues that we're all seeing on television, really is a focus on budgets, revenue, and the economy. And interestingly enough, 5 years ago this week, the U.S. Supreme Court ruled in the South Dakota versus Wayfair decision. It was a 5-4 decision by the Supreme Court. And basically what this did is it overturned a two-decade-old ruling to collect tax on remote sales. And prior to this ruling, people would voluntarily comply or probably not submit voluntarily taxes on purchases over the internet via e-commerce. This came into effect in 2018. And really, it was the perfect timing for all state and local governments, especially because the pandemic was about to become upon us. And as a result, as we were in lockdown, people were staying home and not traveling. People started buying on the internet, and sales tax revenues really jumped. In fact, in 2021, it jumped 10%. In 2022, it was up 14%, so some significant growth. The U.S. General Accounting Office estimated that in 2022, over $23 billion came from remote tax purchases, so sales tax purchases over the internet in 2022. And prior to the pandemic, it was $7 billion. So we had a huge increase during that period. And I think for many, it was the reliance on sales tax really grew at the state and federal level and local level as a result of that. And so I think something to point out. And at the same time, we were seeing falling corporate income taxes and personal income tax revenue started to decline at that point. So that's something that I think is important to point out. I'm particularly proud of Avenue's involvement with the Wayfair decision. We were very good partners with the National Council of State Legislators, the National League of Cities, the U.S. Conference of Mayors, and others, meeting on a regular basis, trying to shape the rules that would create a fair and balanced system for online sellers as well as Main Street retailers. So something I wanted to mention. And Avenue is actually pretty involved in the administration of these taxes. For example, in the state of Louisiana, we administer the online purchases for the entire state. We just crossed the $1 billion threshold in terms of revenues collected on behalf of the citizens of the state of Louisiana. So something I think that's pretty interesting. Just in general, we're seeing other revenues really starting to slow down, but sales tax is holding on. It's up maybe 0.1%, so relatively flat, but that's because we were at such a high during the pandemic year. So it's leveling off at this point. The last thing I just wanted to mention, kind of reiterate some of the things Corinne talked about with the partnership with UCLA. We're really proud of it because of Our ability at our level is to really look at sales tax from the bottom up, looking at the micro pieces, whereas the state and Jerry's group work at it more macro. So we give you a forecast from the bottom up, plus that macro perspective from UCLA. And we're here to help you in any way we can. Again, because of our national presence, we're pretty fluent in all the different states that are out there. So with that, Corinne, I hand it back to you. Thank you.
Well, thank you for a brief update that was chock full of information and insight. Thank you. So let's move over and kick off the economic forecast with Jerry. Jerry, please take it away.
Okay, so let's talk about the economy, and I'm going to share my screen. I have some slides, but this is going to be interactive. So put your questions in, and we'll talk about this as we go along. Can you all see the slides okay?
Yes.
Great. So to start out with, I have a picture here of the Federal Reserve Board of Governors building in Washington, D.C. And the reason for the picture is that what happens inside these halls of the Fed's building has a real impact on the economy and on our forecast. But we're talking about a time when, and I think this is not controversial, the economic outlook is very uncertain. And so what we want to do is look at data and see what it says. And there are two, I think, important messages in this presentation. One is that the Fed, at least to this point, has not been able to influence the economy in the way that it expected and in the way that has happened in the past. We'll talk about that. And the second is the impact of increases in interest rates and the slowing, to the extent that it's slowing, of the economy is very dependent on where you are. And we'll talk about that dependence. So let's just jump right in and look at our major metric for what's happening in the economy, and that's GDP. And the slide that you see here has both blue and red, and the blues are actuals, the reds are our forecast, and the green line is another forecast that we did, which is a recession scenario. So we are still at the point where there might be a mild recession coming later this year. And the reason why we're uncertain is that monetary policy doesn't work directly. It's a fairly blunt instrument. It raises interest rates. It affects interest-sensitive sectors, and we're going to go through those interest-sensitive sectors. But as Milton Friedman famously said many, many decades ago, monetary policy affects the economy with long and variable lags. And those long and variable lags empirically seem to be somewhere between 6 and 12 months. So we're about 3 months away from finding out if they actually had the kind of impact that might lead to a recession. So that's why you have the recession scenario, but it's fairly mild. And then the dashed line that you see here is the 2.4% trend from 2018 and 2019. And what you notice is that even the blues where we are today are below trend, and we are not back to trend through our forecast. So that's kind of the macro look here. Before I go on, are there any questions or clarifying questions about this?
Yeah, actually, Jerry, just to jump in, as we're looking at it from a micro level at the local level in various states that we're working, this really mirrors the way sales tax revenues are going. It follows the exact same line. We're seeing a slight dip. We're coming back, but not quite as good as we were pre-pandemic. So the sales tax revenue at the local level are following what you just described.
So, and a question did come in. I think you did cover this a little bit, but it bears worth repeating. Many articles out there state that the economy has fully recovered from the pandemic. Do you agree? And if not, how many years or how much time will it take to fully recover?
So that's a great question. And a lot of that depends on what does one mean by fully recovered. If you look at those blue blocks there, you'll notice that they are, as you move kind of to the right towards the red, that they're higher than the ones on the left that are prior to that big dip in the 2020 recession. And so in that sense, it has recovered. GDP, economic activity, is higher today than it was before the pandemic, but it's below trend. So if it's below trend, has it really recovered? Well, we have to ask, why is it below trend? And let me go to the next slide, because I think this is going to answer that question. What you see here is labor force participation. And on the left-hand side, so just look at the left-hand panel, that's everyone over 16, age 16. And there's this long secular drop in labor force participation long before the 2020 recession, but it kind of levels out. Then it drops with the lockdown, and then it comes back, and it comes back to within 1.1% of its previous peak. And the reason why it didn't come all the way back is in the right-hand side. These are boomers. So in this chart, you see that that there's kind of a bucking of the trend from the Great Recession of 2008, 2009, all the way up to 2020. And there are two reasons. One is more people aged into the greater than 65-year-old category. But the second is that we use equity in our homes as part of our retirement savings. And in 2010, 2011, we didn't have any equity in our homes. Many homes had negative equity. So boomers stayed in the labor force. And then you get to 2020, they're 10 years older, they have lots of equity in their homes, and they retire by the millions. And that's a 9.2% drop. And you notice that doesn't come back. And so we have a smaller labor force. And so in your mind, imagine that previous graph and just bring that dashed line down to reflect that we have a smaller labor force, fewer people working, therefore potential GDP is lower. And if you do that, we are in fact at full employment and fully recovered in that sense. So moving on, we've been talking about briefly the Federal Reserve and Federal Reserve policy. So it's worthwhile to take some time and talk about inflation and, what is the Fed worried about? So this is the change in the consumer price index year over year. So it's now from May of 2023 compared to May of 2022. And you notice the 4% there, and it has been coming down and coming down sharply. What the Fed's worried about is in this red circle here. And that is a period of high and sustained inflation. The two peaks there relate to the oil price shocks in the 70s. But it was, the underlying inflation was very high, and interest rates went up to 18%. That was the Federal Reserve's moving interest rates to 18%, inducing a big recession to squeeze that inflation out. The Fed is really worried that the inflation that we see now, which is still only 4%, is a lot like what's in that red circle. And if that's the case, they want to cool the economy, even at the risk of a recession, to squeeze inflation out and get the inflation rate down to the 2% range. But if you keep moving your eyes to the left, you see these two arrows, and they also look very much like today. And those were 1947 and 1953, the end of World War II and the end of the Korean War. And what happened there was the GIs came home. They had lots of money they wanted to spend, and the economy was oriented around building war material, supporting the war effort. So we had what's akin to supply chain constraints, an economy that wasn't producing a sufficient amount of what people wanted to buy. In the 2020 recession, households, unlike other recessions, ended up having very good balance sheets. We came out of that, and this is in part, maybe in large part, due to the big transfers that we had. We came out of that with households having a lot of money, and we wanted to spend. We had been locked down for 15 months, and the economy had supply chain constraints because of the pandemic. So how much is the black arrows? How much is the red circle? No one really knows. So the Fed is trying to take a conservative stance and say, let's assume that a lot of this is the red circle and set policy accordingly. So it's worthwhile to say, well, what gives us that 4%, and what has been happening recently, say the last 6 months, because this is year over year. Well, the last 6 months, it's come down a little, 3.6% on an annual rate. So that's not coming down fast. And that's why Chairman Powell said, yes, we didn't raise interest rates this month, but wait till next month.
Jerry, what is the lag time from the federal changing interest rates? Like how much of a lag time will it be to see an effect?
So that's another great question. And the answer is we really don't know, but historically, it's been around 9 months. And in Christine Romer's presidential address to the American Economic Association just a month ago, she presented evidence that it's about 6 to 9 months, which means that it's a recession and low inflation should be here right now. And we see neither. So maybe another 3 months, but it shouldn't be longer than that. So we'll see over the summer. We don't expect inflation to come down very much more over the summer, but the underlying economy is really strong. And so we also don't expect a recession to happen over the summer. Okay, so
Got it.
let's break down inflation. The way in which inflation metrics are constructed is a basket of goods are taken and the change in prices for each of those goods is measured. And then it's weighted by the percentage of the average household's budget is in that particular goods category. And so what you see here is the cumulative contribution to inflation. So going left to right are a whole set of categories: energy, used cars, alcohol, and so on. And the orange is the contribution of that particular category, and the orange plus the blue is the total contribution. And you notice it's all below zero. Some of the oranges are a little positive, but the total is below zero till you get over to the right-hand side. There are really only three things generating that 4% inflation. One is other transportation, and that is in auto insurance and auto repairs, and somewhat in those airplane tickets that we've seen go up dramatically, although the prices are coming down now. The next is food, and the big one here is shelter, and shelter accounts for 34% of the CPI. The measure the Fed uses, shelter accounts for 30% of CPI. And this is not home prices, this is rents. And rents, this is the average rents that people are paying. And so it's an average over the last 12 months. And we've been seeing new rent contracts at lower rental rates than previously. So this will come down, and Kareem, back to your question, this comes down slowly because the lease contracts have to roll over to get the lower lease rates, and that takes time. So none of these are affected by increases in interest rates. In fact, shelter is the opposite because higher interest rates means fewer homes purchased and more people in the rental market, and that pushes up rents rather than down. So what is the Fed trying to affect? The interest-sensitive sectors, autos, houses, durable goods manufacturing and business investment, and structures, particularly business structures. And so we're going to take a look at those and see what the data tells us about the impact of these higher interest rates. But let's get a little historical perspective. This chart shows you increases and decreases in the federal funds rate. And when the Fed kind of changed their mind and started decreasing. So the reds are the increases, the blues are the decreases, and you see dots there. And this is one of the problems of doing forecasts today, is there are only 8 dots. So that's a very small sample. 2 are green, which means that the Fed turned around and started lowering interest rates, and there wasn't an ensuing recession. And 4 are red. 6 are red. But two of the reds are probably not very informative. One, because we had a recession, but it was because of a pandemic, and interest rates obviously didn't cause the pandemic. And the second is the Volcker shock, which was created with the intention of creating a recession. So the others are sort of more soft landing, and that gives you 4 recessions, 2 non-recessions. The Fed would like to hit a green dot. They're willing to hit a red dot, but there's a lot of uncertainty as to which is going to happen. So,
And I'm sorry, what did you call that? The what show? What did you term that?
oh, so in 1981, we had very high inflation, and the Federal Reserve, in order to squeeze that inflation out, boosted interest rates rapidly into very high levels. And that is often called the Volcker shock because of Chairman Volcker, who was chairman of the Federal Reserve at that time.
Thank you. I'd never heard of that. Thank you.
So, what this says is that the Fed is somewhat flying blind, but this is their intention. So let's start looking at some of these sectors. And here's the first one. And I think this is kind of really important as we go across the country and think about where people are spending money, where they are traveling to. And this is from a New York Times Magazine article. And it says stress builds as office building owners and lenders haggle over debt. What's going on in the office market is that there are high vacancy rates. San Francisco and downtown Los Angeles, for example, have 30% vacancy rates in their office buildings. And that means that the previous pre-pandemic valuation of office buildings is too high. And loans against those buildings are loans with very low interest rates that now have to be refinanced. So we have a rebasing and rebasing of both values and lease rates, and that takes time. We're going to see foreclosures and the like, and a key element of this is work from home. So if people are not going into the office, they're not spending near the office. That certainly affects across the country, but across the country, it's really different as to the percentage of folks who are going into the office. A lot of that depends on what kind of work that they are doing. So that leads me to, Fran, love to get your perspective on what's happening locally with work from home and how's that differential impact on sales and property taxes kind of across the country. What makes it different, say, in, I don't know, New Orleans versus San Francisco?
No, I think it's a great question. And I think the answer starts with every city's business space is very different. Cities that have a high reliance on people coming to the office in a community, and then when they're there spending money for lunches or entertainment or consumption of goods, things like that, are more impacted than cities that might be, quote unquote, more residential and that sort of thing, more suburban. So in cities that we work with, there's examples where cities have, in pre-pandemic, would have 30, there's one city had 45,000 daily workers in the community and only 13,000 permanent residents. That particular city's local revenues, sales tax in particular, were hit terribly, and a lot of retail businesses had to close down. So in that kind of situation, we saw major impacts. Whereas in some of the residential communities, their sales tax revenues were increasing at the local stores and things because people were working at home. They're staying home, going out to lunch perhaps, or shopping locally. We saw a real correlation to residential communities' increase in sales tax in particular. And then on the property tax side, relatively flat, but as the values of commercial buildings may be impacted, as you described, Jerry, that's going to have an impact on the property taxes as well.
Yeah, so it really depends, doesn't it, as to what kind of concentration, but then also what kind of work is being done in the office?
Exactly. Yeah, I think so. We have one client city that has a lot of aerospace and high tech, so a lot of that's secretive. So they came back out of the pandemic quickly, and we saw the correlation as those people came back into the office, the sales tax revenues kicked up pretty dramatically, very quickly.
And Fran, I hate to put you on the spot, but I know you and I had a conversation just the other day. I found it really interesting. But you were talking about vehicle miles traveled, that vehicle miles traveled was going down and that it was impacting service stations.
Yeah, that's just gas prices.
About that?
Yeah, no, I'd be happy to talk about that a little bit. Gas prices, I think, is a huge part of this whole conversation. The big story right now is we're seeing a decline in local sales tax revenue as gas prices across the country have started coming down. In some cases, it's down 16%. So that's a big impact. A lot of that has to do with the people throttling back on travel and consumption. So the price is down across the board. But what we saw is for over the last 36 to 37 years, miles traveled in this country went from 77.4 trillion driven miles to today up to 267.1 trillion miles. So about a 345% increase over the last 36, 37 years, or about 9.5% annually. What we're seeing is gas prices are continuing to come down, and there's a correlation to electric vehicles as well. So in many places, we're seeing the increase in purchase of electric vehicles, which means less consumption of gasoline. So there's a direct correlation to gas prices there. And in so many cities, we have such narrow tax bases that there's a big reliance in California, for example, on car sales, general retail, and gas prices. It's one of the narrowest in the country. You go to a state like Texas, you have a broader base. Certain things are not taxed, like car sales, perhaps, but they come out of recoveries a lot quicker. So the narrower the tax base and the reliance on key pieces, the bigger the change. And as a result, we're seeing gas prices being a major driver of the local sales tax.
So Fran, I have a question for you. Is the electric for an electric vehicle, is that taxable?
Great question.
Is the electric on that?
Yeah,
taxable?
so the purchase of in most states, a purchase of an electric car would be no different than a purchase of a fuel fossil consuming car. So there's no difference there. The difference you lose is you're not buying gasoline, which in most places is taxable. So you're not being charged on that, but you do see an increase perhaps in some of the telecom, consumption of electricity. And if a particular state or has a tax on electricity, they'll make some money back up there, but it's harder to quantify. But I think overall that increase in the electric utility tax, if it's one of those, is not going to be the same as the increase in the amount consumed in gas tax. So I don't think it correlates really well. But you'll get some back, but and of course there's benefits to the environment, but that doesn't impact the revenues per se.
Got it. Thank you.
You bet.
Okay, so I just got back from vacation. So Fran, I'm doing my job of holding up the gasoline tax.
Good.
Before we leave structures, because this is an interest-sensitive sector, what is really interesting is that it's in office buildings that we're seeing a lot of stress. Retail, which has been kind of dead in the water for a number of years, is now starting to come back for two reasons. One is we have new housing developments, and as Fran said, people are shopping more around their neighborhoods. And so the economy has burned off a lot of the redundant retail space. The second is the pandemic taught us we want to be with other people. And so experiential retail is coming back fairly strongly. Industrial space, and we're going to talk about manufacturing next, but industrial space with respect to warehouses, the fragility of these supply chains means that companies are keeping larger inventories. They need more warehouse space, so industrial is doing well. Oil drilling rigs is doing well. So when you add all that up, we find that in the aggregate, in spite of what's happening in the office building space, that construction of new structures is actually increasing, not decreasing. So let's turn to manufacturing. Oh, no, let's turn to consumption first, because this is 70% of GDP. And Fran was talking about that earlier and the impact on sales tax. And so the shaded area is the 2020 recession. And if we take a trend line, we're still above trend. People are getting jobs, they're earning more money, they are spending, and they're not seeing a recession. this being almost 70% of GDP, is holding up a very strong economy. And so you see a few blips here, but one of the things that I think is important, depending on what state you're in, is there has been a shift from goods purchases to services purchases, in particular restaurants and entertainment and the like. And so certainly in my state, California, that means a reduction in sales taxes because services are not taxed where goods sales are. So that's a kind of important part in the realm of local taxes. But in terms of the economy, the demand is still strong for consumption.
Right. And Jerry, to add to that, we're starting to see a trend where products like electronics and furniture and bedding, appliances, sporting goods, things like that are starting to see some significant price drops. I think a lot of that demand purchasing during the pandemic has passed. So we're starting to see a correlation to a decrease in the sales tax revenues, to your point. And as gas prices and oils and things used in those products have come down, we're seeing the price go down, necessarily about consumption, but again, the prices are coming down, and we're starting to see drops in price correlating to all of that, and has an impact on the sales tax.
Right. And how many electric bikes can you actually own, right?
Right.
We sort of doubled down on that during the pandemic, but now is moving towards normalization. But nevertheless, consumption's holding up. So let's take a look at other interest-sensitive sectors. In particular, I want to look at manufacturing. I'm going to do this in the context of California, but I think it's illustrative of the way to think about this across the country and what's going to drive manufacturing to grow or shrink. And so this is payroll employment in durable goods manufacturing in California. And you notice it's retreated a little bit, but it is at record levels. Not record historically, but if you go back to before the Great Recession, so certainly, over the last 15 to 20 years, this is at record levels of employment today in manufacturing. And if we break this down by what's happened to productivity and look at that kind of across the country, we see that California, which is over on the left, has had a dramatic increase in manufacturing productivity. And if we kind of go over to the right, let's pick on, North Carolina, but we'll pick on North Carolina for the moment, and you see a productivity decrease. It's not because factory workers in North Carolina are on Facebook and or on TikTok instead of working. It's because the growth in manufacturing in North Carolina has been of a kind of manufacturing that has lower than average productivity for the state. And the opposite is true in California. So this decrease that you see here in employment in California, if we break that down by where the decrease is, it's in furniture, it's in wood products, in something called miscellaneous, it's in metal bending, it's in traditional manufacturing. And where is their growth? Computers and peripheral, transportation equipment, which is in particular sophisticated transportation equipment, semiconductors, and navigational equipment. So it's in high tech. What we're seeing, and this is, in part, maybe large part, due to incentives through a number of government programs, including the CHIPS Act, is real growth in manufacturing that relates to technology, that's advanced manufacturing. And that's where we're seeing factories all across the country where they're being opened up, they're being built to do advanced manufacturing. So manufacturing is changing, but it is growing. But what's important is where that manufacturing is going. And I want to give you an illustration of this. So this is going to be anecdotal, but if you think about California, California is, never very much off the bottom of any measure of business friendliness. It is certainly a high cost of living state. But here are 5 pictures of new factories that are being built today. And so upper right-hand side, Tesla, who has factories in Nevada and in Texas, is building a large energy storage manufacturing factory in Lathrop, not too far outside of San Francisco. Evercharge, also in the Bay Area, building a factory for EV charging stations. Bosch, a semiconductor factory in Roseville near Sacramento. Northrop in Los Angeles County, building airplanes, and a new factory in Palmdale. And the one over on the right, Scorpios, the picture there is actually their factory in Austin, Texas, that they're closing down and moving it to Temecula in California, north of San Diego. So why are these factories coming into this high-cost, business-unfriendly state? It has to do with the labor force and the deep labor force that California has in technical skills. So as you look across the country, where is there growth in manufacturing? It's where the labor force can support it, where you have the skill sets for this kind of advanced manufacturing that is the new durable goods manufacturing. And a lot of this is new investment and not that interest sensitive. So that means those areas are going to buck the trend. And that leads us to another part of manufacturing, which is real defense purchases.
Jerry, before we go
Sure.
into defense, I have a question. So
Sure,
what
let's
does that
go back
look
to
like? So what did manufacturing, so before it went from traditional, what percentages did that flip to the IT sector? Like, so what was it before, like 5 years ago, and what is it now, the manufacturing in the high-tech sector?
So what's important to note is we don't really have a high-tech sector. So, you look here, and the semiconductors is certainly in durable goods manufacturing, and it has a sector. But the airplane that's on the lower left is in aviation and so on. So we don't really have a high-tech sector. But when we saw manufacturing leave the US, particularly for China, but also for elsewhere, what we saw was manufacturing that used a lot of labor. And now the manufacturing that we're seeing, even in some of those traditional products, is using robots. So, for example, if you look at a new auto manufacturing plant, you'll find a lot of robots and not as many people. Only about half the number that were working there before. So I don't have the exact percentage, but I think one can rest assured that this is happening fairly rapidly. And where it's not happening, other countries, Mexico maybe, or Vietnam, still look very attractive for offshoring.
Yeah, and just to add, the other thing that's to be noted about all these examples Jerry showed is there's a large amount of sales tax related to each of these purchases. It's called use tax in most cases, meaning those robotics that you see are probably coming from another state, another country. As they come in, there's a taxable amount. It's a one-time tax on that. So $1 million machine, you start adding the tax up, it's very significant. So in all of these examples, these cities are likely working with us or on their own to accrue that use tax so they get those big one-time purchases, and it's very significant amounts of revenue that are coming in as a part of the equipment utilized in this operation to be built up. So
and it's Fran, it's really interesting where you see new factories going in. They're in New York, they're in Connecticut, in Georgia, which is not a low tax state.
Right.
So these factories are going in where you find the workforce that can support them.
Exactly, and the tax dollars
look for locally.
Right, and the tax dollars go to all those states that are building those factories when they use this equipment or purchase the equipment involved. So it's something to look at across the country.
Right, and then another component of that is we live in a more dangerous world. Defense purchases are going up. And so the two on the right are 2023, that goes through October. And then 2024, higher purchases of defense durable goods, some as a replacement for what we're sending to Europe, to Ukraine, but also our defense purchases for our own military going up. This is high tech defense manufacturing. It's not interest sensitive, but it is an increase in demand in the economy. As well, our allies in Europe and Asia are also buying more defense goods, and some of that is coming to the US. And that isn't spread around evenly. If you look at just this table, this is total defense spending, so it includes military bases. And you see it's a small number of states get the vast majority of this. And if we go down the list, so Texas has defense durable goods manufacturing, California, Connecticut, Arizona. So it's going to a few states, but not all states. So that's going to be a differential demand as we go across the US. And the economy grows, but it doesn't grow as rapidly in some places as others.
I'm happy to see Virginia on that list, which is where Avenue's headquartered. So go Virginia. So for these top 10 states here, do you anticipate a boom in construction tied with this?
So it depends. I mean, Virginia and Maryland, Florida have a large number of significant defense facilities. And so that's not manufacturing. And also, in Virginia and Maryland, you have a number of defense companies that are receiving contracts, but the money is going to where their factories are. So is there going to be significant building in Virginia? I guess that's an open question. I don't know the answer to that. But it's quite possible there's going to be new manufacturing. There is going to be new manufacturing in Virginia, but how significant, I don't know. Okay, moving on, we've heard about tech employment and tech layoffs. This is professional, scientific, and technical services employment in the state of California. Again, this is California as an illustration for the US. And even if you squint, you can't see the layoffs here. Those layoffs were among very large, mature tech firms that are multinationals. Part of their layoffs were abroad. The layoffs were spread across the country, but tech is growing. And so the people who are laid off are being hired by the smaller tech firms. Venture capital is going up. And so in the aggregate, we're not seeing a decrease in employment. What is important here is that smaller tech firms compensate their employees with deferred compensation like stock options and lower salaries. So that definitely impacts consumer purchases, impacts sales taxes where this is happening. So you think of Nashville and Austin and Seattle and San Francisco and the like, and so that is going to be the impact. But is tech going to shrink because of these higher interest rates? Well, possibly, but the new darling of tech is a transformational innovation, which we know as AI. And money is pouring into AI, and that's going to keep tech growing through these next few years as the Fed is trying to slow the economy. So again, we have higher interest rates, but another potential interest-sensitive sector is not responding in the way it might have in the past.
And I'm happy to let our audience know we are all three real people here. No AI today.
Or at least you should think so. Okay, so let's turn to housing, because housing is certainly interest sensitive, and this is the Case-Shiller Home Price Index. And so it goes from 2000 up to present. And what you see is that minus 27%, that's the Great Recession. And that's because a large number of homes were occupied by folks who actually couldn't afford to make their mortgage payments. And so banks were blowing out those houses after foreclosures, and there were a lot of them. Now we have some decline, depending on whether we are in the recession or the no recession scenario. We have some decline of about maybe 5 to 8%, and that's just an adjustment to higher interest rates, keeping the total payment that folks are making, relatively constant. So that would be expected. So no big decrease. And in fact, we're starting to see some increases in some markets in home prices. One of the things that is significant is that because many folks are locked into very low interest rate mortgages, they're not giving those up to get a 6.5% to 7% mortgage and move. And so there's very little inventory on the market for those who can qualify to purchase homes. And because there's very little inventory, they're buying new homes. And so the inventory of new homes is going down, prices not so much. And that is leading to some increase in building going forward. Exactly the opposite of what increases in interest rates is supposed to achieve. But if we look at up till today, so this is during the interest rate increases by the Fed. On the left is 2021 to 2022 building permit growth. And you see California, Texas, and Florida pretty much flat. 2022, same as 2021. Some over on the left, Tennessee, Utah, and so on, have a decrease. In the first quarter of 2023, that's the right-hand graph, everyone seems to be declining, but really at different rates. So again, it depends on local markets. And as we know, housing is everywhere local. But in some places, you still have a real shortage of housing. So you think of Texas and Florida because of the in-migration, California because of a small amount of building that has gone on over the past decade. And so there's still strong demand. And then if we look at going forward, this is housing starts. And so we have our no recession and recession scenario, and they're pretty similar because we haven't overbuilt housing. You get a dip in the recession scenario, but these numbers, if you look at the first ones where the two lines diverge, so that's a forecast, and the top one, which is no recession, that's the current quarter, is 1.4 million. The average for the US over time is 1.5 million. The May numbers just came out at 1.65, 1.63 million. And so way above actually our forecast for the average for the quarter. Now, the previous quarter was a little below 1.4 million, so we still might hit that. But the point is, increases in interest rates are not driving down new home construction, and new home construction declines are usually associated with recessions. They usually drive us into recessions. So this is telling us the underlying economy is strong, and the pressures to keep growing are really there.
Before we move on, do you mind going back? Fran, I'd love to hear your take on it from a micro level on housing and construction.
Sure. Yeah, I think it's interesting. From a local level, the construction usually is about, and housing remodels, either retail or wholesale, is about 9 to 11% of a typical state's sales tax base. We've definitely seen a decline in the revenues from home improvement stores such as a Lowe's or a Home Depot or people of that nature. The revenues are really flattened down. I think we're starting to see that people have kind of burnt out on doing the remodels that they were all doing during the pandemic. Those types, I think people are kind of done now. They want to get out and do other things. So that's, I think, a big part of why we see sales tax revenue flattening out for the short term, is just a decline on that front. So, for example, for the fourth quarter of 2022 in California, retail for building materials was down about 8.9%. and down 4.1% for wholesale. So we saw less of a decrease in wholesale building, which would be the homes that Jerry talked about, or other types of construction. So we definitely see a flattening. We don't expect that to last very long. I think it correlates with the trajectory that Jerry's just described, but currently that's having an impact on state and local sales tax for sure.
Yeah, and again, it's everywhere local. So, the expectation of it increasing in California, I think, is fairly solid. But if you consider, for example, the city of Phoenix, where home construction is really slowing down, both because of water and because it's kind of caught up to the in-migration into Phoenix, which has been fairly dramatic. You're going to be seeing less construction. So local factors are really important here.
And
Absolutely.
so, Jerry, aside from interest rates, are there other factors that can influence the demand for housing?
The answer is yes, and I think California provides, also Minneapolis, and other cities are considering this, provide an example. So California has 6 laws that have been passed in the last 3 years that override local zoning and allow for granny flats for ADUs to be built in single-family zoned areas, and also transit-oriented multifamily housing. That has created new products that have decent rates of return, more affordable housing, and we're seeing that. In Minneapolis, we saw the growth of that to about 20% of all new permits. We see that in the county of Los Angeles, about 20% of new permits, and so there are policies that will bring new products to market to satisfy demand where you have excess demand, like California, in high cost of living areas. So not so much in places where housing prices haven't appreciated as much. Okay, so moving on. So where will interest rates actually have an impact and affect whether or not we have a recession in the next 12 months? The answer is right here. It's in real business fixed investment. It's in equipment and software. We're not seeing much of this now. We have labor shortages we're seeing in the services. Think about restaurants, for example, investment in software, investment in labor saving equipment and software. We're seeing new innovations. But if we do get a recession, this is where it's going to happen. So this is where we should keep our eyes peeled for a clue as to whether the economy is going to keep chugging away in spite of the Fed, or is going to go into a recession. And again, we don't see the evidence of that yet, but it's where we're going to be looking as we look forward. And then inflation, which is what this was kind of all about in the first place. Our forecast has inflation coming down in the no recession scenario a little faster. That keeps the Fed from raising interest rates quite as high. And then in the recession scenario, when you get the recession late 2023, inflation comes down kind of more rapidly, but some of the things like rents are going to take time. And so we really don't get into the twos until we're into the mid 2024. So that is the inflation story. And just to summarize, in the US, employment and income are strong. The underlying US economy is quite strong. The interest rate rises, they probably cool the economy some, but we don't really see housing construction and automobile purchases or automobile manufacturing hurt the way it has been historically. Infrastructure and defense are going to add demand to the economy. And the open question is how much past and possible future interest rate increases are going to cool the economy. We don't know. We haven't really seen a lot yet. So late 2023 recession, at this point, it's kind of flip a coin, but it's moving in the direction of don't flip a coin. It's less likely than more likely.
Right.
So Jerry, if we go into a recession, no, this question hasn't come through yet. This is my question. If we go sluggish to recession for the second half of 2023, how long will that last? When will we start going back up?
So the expectation is that it will only be a couple of quarters, and it'll be very mild. It'll be similar to the 2001 recession, which was a mild recession across the country. If you're sitting in the Bay Area, you would say, no, it wasn't, but the average for the country was a very mild recession.
And I think that relates to the same on the local level in terms of sales tax consumption. It goes back to what Jerry talked about earlier. We have low unemployment. People still have pent up energy to travel and to be with family and be on vacations. People are spending. It's leveling out, but it's not slowing down. And I think the key fundamental is we have such low unemployment in general across the country. So we're feeling the same way about the sales tax revenues. A couple quarters of flattening out, that's we're in right now, but coming back out of it as we get into early next year.
Yeah, as long as we have sub 4% unemployment, the economy is doing well, right? It's full employment, people have jobs. An interesting thing is that, and this is kind of unusual in the measures of consumer sentiment, is that in the questions asked to individuals and households, how is your economic position? How are you feeling about yourself and your financial position going forward into the future? And the answer is, I feel great. I don't expect to be unemployed, and I have plenty of money, etc. And then the question is asked, well, what do you think about the economy? Oh, the economy is terrible. And so everyone thinks they're doing well, and they think the rest of us are doing poorly. And so that's kind of a very unusual thing that's been happening in consumer sentiment, which means we can't rely on that metric very much as a leading indicator of what's going to happen in the economy.
So I know we're coming up to the top of the hour, and but I know we still just have one more quick slide to go through to cover geopolitical risks.
And before we go there,
we will send a recording out, but I'd love, Jerry, to hear your take on the geopolitical risks.
Okay, before I do that, I just brought up Silicon Valley Bank. The other thing to look at is there underlying systemic risk in the non-bank financial sector that we don't know about? Non-bank financial sector is large. Did Silicon Valley Bank, Signature Bank, etc., indicate something is going on there? It looks like the answer is no, but it's a place to keep our eyes on. Okay, let's quickly do.
And I'm sorry, I'm just going to squeeze the one question that just came in. How will payment of student loan debt starting up in October impact the economy?
So good question. The answer really is not too much. A lot of the student loan debt is sort of the big bulk of it, about a third of it is to students to individuals who are still students. So they weren't paying it anyway. And a big chunk of it is to people who kept paying it. And so in the aggregate, it's fairly small. And it is something that folks have known is coming. So presumably they put aside some savings for that. So we don't expect that to have much of an impact. Okay, let's talk about geopolitical. Russia and Ukraine, not much to say about that. But these are things that could upset the apple cart here. China, Taiwan, none of these are big surprises. This one, as we look forward, climate change migration, we're already starting to see this from Africa, from Central America, from parts of the Middle East, and it's only going to increase. And what impact that's going to have is unknown, but we're going to see a lot of migration over the next decade. And India and Pakistan, they are not BFFs, and they are both nuclear powers. So these are places to keep our eyes on of things that might really make the forecast that we were just talking about not be a very good forecast, because the world could change very rapidly based on geopolitical events.
And just to add to that, I think some political things that are taking place right now, especially this past week, should be noted with Secretary of State Blinken being in China, meeting with the leadership there. I think that's an important one, regardless of your views about China and or Taiwan. The fact is communications have started up. I think the world powers recognize that somehow we have to tamp things down a little bit. It impacts not just our livelihoods, our safety, I should say, but it also certainly has an impact on our economics and trade and importing and exporting. So I think that's one issue to really pay attention to in the coming weeks, and hopefully that leads us in a positive direction.
Yeah,
All right.
I think that's right. It's still, a very tense area, and as well, what's happening in Ukraine has much wider implications potentially than just the ongoing war.
Yeah, I think Jerry makes a really good point, especially the Ukraine in their terms of production of grain and things. We see some African countries trying to lobby to mitigate the situation, for example. So the war has implications not just on tax and revenue, but on food supplies and things of that nature, which is becoming a bigger part of the conversation for sure.
All right. Well, again, another action-packed forecast. So that's all we have time for today. So thank you so much, Jerry and Fran. Presentation, as always, was fabulous. Great forecast and helping to everyone to prepare for the possibilities ahead. And Jerry, I forgot to mention, I like the crystal ball with the Band-Aid at the very top. So if you're open to try that.
I think that's what we need today. Maybe we need 2 Band-Aids.
Indeed.
So, and thank you to our audience for tuning in today and for sending in your questions. That was very helpful and helps make it very interactive. Really appreciate that. We hope you found this information to be insightful. And we're going to email you a link to the recording of the website in case you missed part of it or would like to share it with a colleague. So thanks again and have a great rest of your day.
Great. Thank you.